Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for this segment, we have Phil Mackintosh, Chief Economist at Nasdaq. Phil, it's great to see you as always. Welcome back to Trade Talks. And it seems as if stocks have kind of done a double take to kick off the first few trading sessions of the year.
Yeah, so much for the strong returns last year. It's been a much tougher year so far, but it's early on. And really what we've seen is a response to interest rates going up. The market has sort of had a little bit of a sell-off, especially in growth stocks in I guess, a week ago. The last couple of days, we're starting to see that correct just a little bit. But most of what we're seeing is in response to rates rising. The 10-year rate has actually increased around about 40 basis points in the space of 3 or 4 weeks.
So, Phil, is this really related to inflation?
Yes, it is. And it's also related to the fact that the Fed has at last acknowledged that inflation is not transitory. It's gotten quite high and they need to actually get it a little bit under control. So back in December, we know that the Fed started to talk about increasing its taper and getting on with getting rates to go back up. Since then, the rhetoric has got, I guess, even more aggressive in the sense of doing things faster and reducing the balance sheet further. Rate hikes starting maybe in March. So the Fed has basically caught up with the market, and you can see the market's expectations were pretty much baked in for 3 rate hikes this year. Now that's getting close to 4. So the market has adjusted just a little bit, but the Fed has adjusted quite a lot in acknowledging that inflation and the sort of overheated economy does need to be cooled down just a little bit.
So, Phil, it sounds like the key for the Fed is getting that inflation number down is the key. So my question to you is, how can a 1% interest rate hike impact 7% inflation?
Really good question, isn't it? So the 1% increase is 4 quarter-point rate hikes. 7% inflation is what we just saw this morning. And in reality, that still means you're losing money if you're putting it into the bank. What's expected to happen is a lot of the inflation right now, you can see it at the pump. It's oil prices have been pushing up energy prices. You know that there's a chip shortage, which has made cars relatively expensive, especially now all the rental companies are back buying cars as well. And so you've got a lot of factors that are not transient, because that's the Fed's word, but probably won't survive us getting over COVID. And also, once we get over COVID, you should see some people come back into the workforce. That'll reduce some of the supply chain constraints. You should see people starting to spend on services instead of products. That should reduce some of the supply chain bottlenecks and the price increases on importing that we're seeing there. So net, I think that inflation that's running at 7% now should come down, and the expectation is for it to get close to 3%. We've got a 10-year now, which is like 1.8-ish. If it goes up roughly 1%, we're actually pretty close to 3%. So 3% versus 3%, you're talking about much more closing the gap than 1% versus 7%.
Phil, one more question for you. To move from 7% to 3%, is that a big feat to make that happen? It kind of sounds like it would take a lot.
Not really. I mean, if you take out the vehicle inflation that we've got now, and you take out the energy inflation, you take out some of the food inflation, and a lot of the food inflation, again, it's because the supply chain on workers. So there's just not enough people that are healthy at some of the food distributors. So if you take that all out and you sort of fix for that, inflation right now for the rest of the sort of complex is running at about 3%. So it's not a stretch at all.
Mm-hmm. All right, Phil, appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.